Okay, good afternoon and welcome back everyone to another market outlook session here for European Nordic markets. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay. And today I have quite a bit to share with you with regards to what we're seeing out of Europe, both in the Nordics and broader Europe as well. What we're seeing in the US, kind of the relative performance between the two, because we have seen Europe underperform the US markets for virtually a decade, but they're starting to see some signs of some outperformance. So I want to highlight that outperformance, show you kind of what levels to pay attention to see if these outperformance numbers can continue, and then more importantly, where you can find opportunities in this particular outperformance that we're currently seeing in Europe. So let's go ahead and get started. But before I do, what we are going to discuss here today is purely for education and demonstration purposes only. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. What I'm going to cover here is a start off of taking a look at where European markets are today relative to US markets. We'll take a look at the markets themselves, and then we'll take a look at the relative performance charts of Europe versus the US. We'll look at, again, like I said, both the Nordic markets as well as broader Europe, and we'll look at both the S&P and the NASDAQ 100 as kind of benchmarks for the US markets. And then I want to take a look at some of the economic numbers coming out of the Nordic countries, as well as the currencies, how that is going to likely affect corporate earnings this particular quarter and going forward, the sector rotation, which sectors are strongest, which sectors are weakest, and that will lead us to picking some trade ideas that you can review further for potentially playing for a European market to continue the outperformance that we've started to see here over the past 6 or 7 months. But the primary question that I want you to be able to walk away from today's session is a clear understanding as to, can Europe start to outperform the US markets in 2023 after nearly a decade of underperformance relative to the US markets? So let's start off by taking a look at the longer term OMX S30 chart. So, this is obviously the COVID sell-off. We had a very strong rally on the back of that up until the middle, towards the end of 2022, where you formed this near double top here around 2,400 or so on the OMX S30. After forming the double top, the market effectively traced 50% of that move, that initial move from that roughly 13,000 to 24,000. It basically gave back about 50% of that towards the end of last year in October of 2023. And that's when we started to see this downtrend that was started to take place throughout the latter half of 2022, start to break out and start to become far more constructive. So basically, since mid-October, November, we have seen the trends of the OMX S30 continue to trend higher here. This is the 26-week moving average. So not only are we trading above the 26 moving average, the moving averages are sloping higher. This really points to a fairly positive bullish outlook here on the Swedish markets. You also see the same thing when we zoom into the OMX S30, the daily chart. We see that same swing uptrend. So this was the downtrend that I was talking about that was broken, and we've now moved to the upside. But you also have a similar smaller downtrend, bearish downtrend that has recently been broken in just the past few days, and that implies a bullish trend here, even on a shorter time frame. So when we look at the Swedish markets, the longer term and short term trends seem to both be aligning to be fairly positive here in Swedish equities. If we take a look at the Copenhagen 25, very similar outcome in terms of the market itself. The Danish markets were much stronger off of the COVID lows, but you had the same double top that retraced about 50% of the initial move. And then recently, over the past same time frame, since around October, November of last year, you've seen a pretty significant move here to the upside that has been largely been confirmed by moving averages sloping higher and the price remaining above that moving average the entire time. You had one pullback to the moving average and a quick bounce higher here. Now, so from a short term, from a longer term perspective, the chart for the Danish markets look very similar to the markets of the Swedish markets. But if we look at the daily chart here of the Danish markets, it actually looks a little stronger here. You have this major level around 1800 or so on the OMX C25, the Copenhagen 25 index. This 1800 level has been a pretty important level all the way from the beginning of 2021 through the middle of 2021 through the beginning of 2022 towards the beginning of 2023. So very important support and resistance level that just in the last couple of days, we've seen a breakout here to the upside. So short-term, long-term trends for the Danish markets look quite incredibly strong on the equity side. Then if we take a look at Helsinki, this is the one out of the Nordic markets that currently looks the weakest, right? You've had a similar type move off of the COVID lows, a failure to actually even reach that double top. You had that divergence, so a bit of weakness here from the from Finland. And what you've seen here is basically a range-bound motion since then. We haven't been able to break out higher the same way that the Swedish and the Danish markets have been able to. So right now, as you can see, the Finnish markets are trading actually below the 26-week moving average. This certainly still implies a bit more of a neutral tone at the moment. I would say a neutral bullish tone here at the moment because the other markets are quite bullish. But we see this 5100 level as a pretty important resistance level that even if we do get a further move here to the upside, that's likely, how much further this can potentially move. From my perspective, trying to enter a short position here in the Finnish markets, the risk reward isn't particularly strong. I would prefer that you wait. If we do get up to that $5,100 level, that would be a much better support risk to reward ratio for a short position here from the Helsinki, from the Finnish markets. And if we zoom into the daily chart, you have a very similar chart. However, what you can notice here is that the trends are very clearly sloped to the downside. So the fact that we've actually broken above the 26-day moving average, but the average is sloping down, is actually, from a risk to reward perspective, a much better position to enter short exposure here in the Finnish markets. So, it's not like every market is exactly the same. The Swedish and Danish markets look far stronger. The Finnish markets look quite a bit weaker. And then if we look at the Norwegian markets, what's interesting about the Norwegian markets is that notice how the rest of the markets, after forming that double top, corrected nearly 50%. The Norwegian markets did not do that at all. It corrected a much smaller amount. So from a relative perspective, the Norwegian markets are actually the strongest out of the Nordic markets. It's starting to trade itself into a bit of a triangle here. So that's something to pay attention to as to, can it continue to outperform? There's certainly some signs that it's slowing down. And if we zoom in here to the daily chart here, you basically have what has been a very range-bound market for the better half of the last year or so. So what we really need to see is a breakout here above that 11,600 level in order to see this move significantly higher here. Right now, my base case is probably more likely that this stays in more of a range-bound market rather than seeing any significant moves to higher or lower. So overall, that's kind of the picture that we see here from the four major Nordic markets. Let's take a look at broader Europe here. Let's look at the Stoxx 600, which includes about 17 European countries. It includes all of the four countries we just reviewed. It's a much larger index. It has about 600. It has 600 constituents across those 17 countries. This is a daily chart here. Now, this chart looks quite similar to the S&P 500. If you look at the US markets, you have basically a peak back here at the beginning of 2022. You've had a pretty significant move to the downside pretty much throughout the year, but it was a very orderly move to the downside. It wasn't a huge sell-off. It was more of a slow grind lower. And just like the S&P 500 and the other European and US markets, we broke out here towards the end of last year. This broke this downtrend and has continued to trend higher here. Basically a series of higher highs and a series of higher lows. That basically continues the trend. And you also notice this level here around 465 or so, which has been a resistance level in the short run, has actually already been broken here to the upside. And that's a little different than what we're seeing here even in the US markets, where we haven't quite broken up to the upside just yet in this most recent move. So this is part of the thesis as to why we're starting to see outperformance here in Europe relative to the US. And when we take a look at the relative charts, it'll become a little bit more clear. But there's a lot of different specific, I would say, areas of Europe, but including greater Europe, that is showing outperformance relative to the US markets. Let's take a look at the NASDAQ 100 index. This is the 100 largest non-financial stocks listed on the NASDAQ exchange. And notice how NASDAQ didn't break out until the beginning of 2023, this downtrend. So NASDAQ is actually pretty far behind. You know, tech really took a beating here last year in terms of outperformance, or rather underperformance, and only at the beginning of this year is starting to see some outperformance here. And only most of that outperformance has been seen over the past couple of weeks. Basically, we have started to see equities trade to new highs, new relative highs, new 52-week highs that we haven't seen tech outperform. So this you can attribute to, in my opinion, the fact that technology companies have started to lay off employees well ahead of the anticipated recession, something that we haven't seen before in the past. But basically, tech companies has been laying off employees throughout all of this period, basically trying to get ahead of a potential decline in earnings, if the economic situation gets worse. So what we have seen as a result of that over the past couple of months is actually tech made quite a bit of a comeback here with regards to outperformance. So if you look at the NASDAQ 100 relative to the S&P 500, it's severely underperformed the S&P 500 since the beginning of 2022, or actually even the end of 2021. But over the past couple of months, we have started to see tech not only catch up, but actually start outperforming the S&P 500. And again, this is, in my opinion, due to the fact that tech over the past 6 months or so, a little bit more than 6 months, have been really trying to get ahead of the curve of what is likely going to be earnings declines over the next year or so as the economic picture starts to get a little weaker. If you look at the S&P 500, same downtrend broken out here at the beginning of 2023. We've come back to retest this trend line now as support and has now bounced higher here. But notice how the S&P 500 has not broken out to new highs, whereas opposed to the NASDAQ I was showing you before has already broken out to new relative highs. So we're starting to continue to see technology outperform, the mega cap or the broader market here, the broader market being the S&P 500 and the NASDAQ 100 being more of a technology focused index. So this is kind of some of the important metrics to pay attention to here in the US. And then if we take a look at the stock 600, which is, like I said, broader Europe, it includes 17 countries, including the 4 Nordic countries. If we look at a chart of stock 600 relative to the S&P 500, now this is a chart from the end of 2020 through today. And what you see here is, for the most part of that time frame, you have virtually no performance, meaning one market has not outperformed or underperformed the other market. With the exception of towards the end of last year, we started to see the broader Europe market outperform the S&P 500. So this level that has been a range-bound market that has been the top end of that chart has now provided support multiple times since the beginning of 2023. Now, what I haven't shown you here is how far this European market has underperformed the S&P 500 over the past year or so, past 10 years or so. This is a chart that pretty much has been in a downtrend since 2015. So we're talking nearly, almost 10 years of underperformance that has resulted in roughly the last 2.5 years of forming this giant base. And now we're in the early stages of what looks like could be the start of outperformance of the European markets relative to the US markets. And specifically, when you're looking at the European markets, when we look at the 4 Nordic countries, it's really Sweden and Danish markets that kind of stand out as where, if you're looking for more specific names, specific sectors, and specific countries, that's where I'm currently seeing some outperformance. So if we also look at the OMX S30, which is the Swedish markets relative to the NASDAQ 100, since the beginning of actually 2020, or rather the middle of 2020, we have seen this outperformance. Again, this is another country that has underperformed the US markets for the past decade or so. And over the last about a year or so, we've started to see far more constructive outperformance relative to the US markets. Now, keep in mind, the NASDAQ is the stronger of the 2 markets in the US, and it's outperforming even the NASDAQ. It's outperforming the S&P 500, and it's outperforming the NASDAQ 100. But you really have to pay attention to this chart because we're pretty close to this test of the trend line, and this very well can continue the outperformance. But we do want to be careful and understand that if we see the Swedish markets start to underperform the NASDAQ 100, this could be a false start, right? We're in the early stages of what could be a long relative outperformance, but we're not quite, we haven't quite seen just enough data to really confirm that, but we're very much near the cusp. So what the benefit of being near the cusp is really the risk to reward ratio, meaning if you start to bet on outperformance of Europe relative to the US, it doesn't take much for you to say that's not working out, cutting your losses and moving on. Meaning you don't have to put a lot at risk to make this particular play that Europe is going to outperform the US because we're so close to the cusp of potentially going back to either same performance or potentially underperformance. And that's the benefit of when you identify these types of trends early on, and specifically within, when you're able to time the markets where you have just tested this outperformance, it's recently confirmed that outperformance. If you get in early, you have a lot of potential upside while taking on relatively small amounts of risk, because the markets don't have to underperform by too much before you can actually start to see this move here to the downside and say, you know what, the outperformance is not continuing. Let's cut this trade. Let's find something else to trade. Okay, so that's something to consider. The other thing to look at is the Swedish markets relative to the S&P 500. If we look at this is a longer term chart. This goes back to 2017. So I pulled up this longer term chart just to show you kind of the underperformance. And this actually goes back further. If you go even further, there's further underperformance. But even from 2017, what you see is this massive underperformance of the Swedish markets relative to the S&P 500 that has now broken out here to the upside. And what's really good is that you've got a bit of a pullback here, which means, again, that the risk to reward ratio of betting on this type of move is fairly strong, because it doesn't have to move much lower before you could cut your losses and take a loss. But the upside is far larger relative to the amount of risk that you have to take. And that's really why I think this is, from a timing perspective, quite strong for this type of view. Next, let's take a look at some of the economics. So we know that over the past year or so, global central banks have embarked on the fastest rate hike cycle we have ever seen in history. And this was all to combat the inflation that really got out of hand as a result of the very loose monetary policy that global central banks embarked on as a result of COVID-19, the pandemic. And that had ramifications of flooding the markets with too much currency, too much money, and drove the prices of goods higher. So now global central banks have basically raised rates to reverse that process, and we have all been keeping our eye on this one primary metric, inflation. Both in the US, you're obviously paying attention to it in European countries as well, but this is the inflation rate here in Sweden. We had the latest reading in March, was a pretty significant decline from the previous month. And what this really starts to show here is a trend starting to form that is showing that the central banks and what they're doing is at least providing the decline, or rather the slowdown in inflation. And this has caused a couple of other important economic numbers to start to show similar trends. Business confidence continued to erode throughout the last year as inflation continued to get out of hand. Over the past 3 months or so, we've seen business confidence start to bounce back higher here. But not only have we seen that in the business confidence, but we've also started to see this in the consumer confidence numbers over the past 6 months or so. So the economic picture is certainly by no means strong, but it's trending back in the right direction, that we were headed in the wrong direction as all of last year. And that's part of why, you look at the markets right now, a lot of questions that I get from investors saying, we're about to head into a recession, interest rates are still continuing to trend higher. How is it possible that equities are moving higher? It really is because equities they're forward-looking. They're not looking at just where we are today, because certainly the picture, if you look at where we are today, doesn't look particularly great. The U.S. is about to go into, or likely is going to go into recession. There's a pretty high probability of that happening. And so is the case for a lot of countries around the world. So how is it that equities can continue to rally in that environment? And it really comes down to the forward-looking mechanism of equities. It's not just looking at what's happening now, but where will we be in 6 months, or where will we be in a year? And the equity markets is giving us a little bit more optimism because of some of these things that are starting to trend in the right direction. So the last thing I want to take a look at here is the Swedish currency rates. Interest rates. What we see here is Sweden is still on this kind of rate hike cycle. We've kind of went from this base of nearly of negative rates to kind of near zero rates to a very fast, rapid hiking cycle that has now normalized a bit into a sort of normal trend, if you will. But 2.5% on the 10-year yield for Swedish bonds is still very much towards the upper bound of the range. Versus if you look at the US on a very similar trajectory, but over the past 6 months or so, that trajectory has actually started to come down. This reflects, the recessionary risk that we see here in the US that's probably higher than the recessionary risk that you see in Sweden. And this has caused the interest rate differential between the US and Sweden to actually be a little bit more favorable towards Swedish markets. And that really has been part of why we have seen the dollar Swedish kroner actually decline from its peak around 111.4 down back to around the 10.4 level here. So, throughout the pandemic, you had a pretty strong move here to the upside in the US dollar. That kind of culminated in this, call it the wedge pattern, that has now become the reversal of this broader trend. So we went from a bullish to bearish reversal, but that bearish reversal basically has resulted in a sideways trading range for the dollar crown. And it's been trading around 10.2 to 10.8 or so over the past almost 8 months or so. But, if we still continue to see the interest rate differential to trend in the direction that I showed you to, where the Swedish 10-year yield continues to grind higher and the 10-year yield in the US continues to grind lower, that really is the potential catalyst for the dollar crown to potentially break out of this trading range and back lower. So that is our current base case here at the moment. But regardless, for now, while the currency remains relatively weak to the US dollar, and you see this similar type thing in Europe, but in Europe, this is a much longer term chart. What you see is that the euro crown is much, much weaker, meaning if you look at the euro crown still trading at 11.3, that's near basically the all-time highs. We're very close to the all-time highs. And this has an effect both, when the US dollar stack and euro stack is currently trading near relative highs, this makes Swedish goods cheaper in Europe. It makes Swedish goods cheaper in the US, which has really attributed to the trade balance. That's why Sweden now has a pretty significant surplus in terms of trade balance. And there's certainly negative effects of a weak currency, meaning Swedish consumers will find it more expensive to buy goods or import goods. Anything that's imported becomes more expensive. But what it does benefit are corporate earnings. So corporations that sell their goods overseas will now, because of the weaker currency, collect more revenue from that weaker Swedish krona. And that's going to show up in corporate earnings. And that really kind of takes us into the next segment of, if you believe in this outperformance and you believe this outperformance can continue, how do you actually potentially trade this? And from my perspective, when you look at all of these, everything I've shown you here as a whole, when you look at the outperformance in the Swedish and Danish markets, you look at the weaker currency, you look at the economic picture that's starting to trend back into the right direction, where within the Swedish markets or where within the specific sectors do you have opportunities? Now, this is what we call a sector rotation chart. And what this gives you a sense for are which sectors are outperforming, which sectors are underperforming. And what you really care about for the most part when you look at the sector rotation are the ones that are kind of on the outside, because the ones on the outside are showing you not just which ones are outperforming, which ones are underperforming, but how much momentum is behind that outperformance. The ones that are closer to the middle might be outperforming or underperforming, but there's not a lot of momentum behind it, meaning there's not, it could be a very small amount of outperformance or underperformance. So those matter less. But the ones that are kind of towards the outside are the ones that are either underperforming or outperforming by a large margin. And those are the ones that you typically want to pay more attention to. So here's telecom. Telecom is outperforming, leading this move here to the upside. In Europe, you have financials, which is no surprise, is leading the underperformance here. You have healthcare that's starting to show some improvement and potentially going to see some outperformance in the early stages. And you also have basic consumer goods that is, has been underperforming, but is starting to trend back into the right direction. It hasn't quite yet gotten to the improving section yet, and certainly still far away from the leading section. But sometimes when you look down here in this particular quadrant, that's when you can find some really early signs of outperformance. It's a little riskier, but this is really where sometimes you find the biggest moves, because that's where you can potentially catch something early onto one of these trends. Versus if you look at telecommunications, it's certainly outperforming, but it's sort of on the later cycle. So, the risks of that, in my opinion, are actually higher, even though it's in the leading quadrant. But regardless, this gives us opportunities to look at and specific sectors to look at. Like I said, I've identified Swedish and Danish markets as relatively strong in terms of the relative performance. If we're playing for that relative performance, you see that the economics in these countries look fairly strong. You look at the currencies, they're fairly weak, which is good for corporate earnings perspective, especially global corporate earnings. And then let's dive into some of the specific names. So the first one I want to take a look at here is EKTA, healthcare stock. They predominantly create radiation type products for oncology purposes. The thing about healthcare is that healthcare tends to be recession proof to some degree, meaning people have to seek healthcare regardless of whether there's a recession or not. So healthcare companies tend to do fairly well in these types of environments. So if we look at this particular stock, we're trading near the bottom end of a trading range, and I think that this is a potential opportunity for this to bounce higher here. So we're looking at the June 82.5, 92.5 call vertical here, where you're spending about 322 crowns for this 10 crown wide debit spread. And this gives you a risk reward ratio of a little better than 2-to-1 if this stock can rally back up into that 92.5 range. So this is really one that we're paying attention to as a potential move higher here. So if I pull up a chart here of, let's pull up a chart. I'll remove one of these moving averages. Whoops. So, this particular stock, as you can see, has broken out from what has been, call it if we zoom out a little bit, you have a long period of underperformance. And then what we've seen recently is this period of what you would call a basing formation, right? Basically, after a long period of underperformance, in order for it to turn around from bearish to bullish, you typically form this type of base. And depending on this type of base, the shape of the base, the size of the base, the length of the base, it will usually give you some sense for the magnitude of the move here to the up of the move higher here. And you have a base that has largely been forming for well over a year. About 18 months it has been forming this base. And the top end of the base is this 77 level or so that has, throughout the period of the base, has formed the resistance level that has now been broken out and tested multiple times as support. And this gives us a fair amount of confidence that this will hold that support level and has the potential to break out higher here. It hasn't broken out higher here, but because we're catching this so close to this particular level, what's good about these types of trade setups is that your upside potential is far larger than the risk that you have to take, because if this declines back into the 76, 75 crown area, I would cut my losses and move on. So I'm only risking here about 6 crowns or so to the downside, versus my upside is fairly significant, because even in a more conservative move here to the upside, I'm targeting well into the high 90s in terms of my upside initial targets. But long term, my targets can be as high as 115, 116 or so to the upside. And I only have to take about 6 crowns worth of risk to the downside, because if this reverses by more than 6 crowns or so, I'd probably get out and move on, right? My thesis that this support level is holding is just not working out. I would cut my losses and move on, while my potential upside here in a name like this is far, far higher, okay? So that's the first opportunity that I see. The next one is in the telecom. And this is because we've seen that telecom sector is still at the moment the leading telecom. So let's take a look at Millicom. Let's take a look at Millicom here. And you have a similar setup, but what you have is that it hasn't broken out here. It only broke out from this small minor move here to the upside. So you've had this congestion zone up into that 180 level. It broke out. It came back to retest this level twice and has bounced off higher here. And what this is really on the earlier side of a potential big move here to the upside, but the bigger chart looks similar. You have a long period of underperformance. You've now formed this long base, and you have some early signs that this base is starting to break out here to the upside. So when you're looking for outperformance here, this is the type of setup that you typically want to look at. You are taking a little bit more risk here, because this really has to go below 180 before I would cut losses, while I'm thinking my upside is somewhere closer to around 260 or so. The risk to reward is still there. It's just not as strong as the one I showed you here before on EKTA for the healthcare name that I'm seeing at the moment. But Millicom is certainly one that I'm also paying attention to, and I'm looking at the June 205, 240 call vertical as a starting point. Here you're risking 950 crowns per contract to potentially make 2,500 crowns. So you still have a risk reward ratio that's nearly 2.5 to 1, actually better than 2.5 to 1. So this type of risk to reward ratio still looks fairly attractive here to the upside. The next one I want to take a look at here is consumer goods. Husqvarna was another one that came across as a potential candidate. So let's take a look at Husqvarna. Similar type setup here as what I was showing you here before, a long period of underperformance, a base that has formed, and you can call this base a lot of different things. You could call it an inverted head and shoulders for those of you that are familiar with that type of pattern. But regardless, you've got the breakout, you've got the retest of the breakout level, and now it's moved higher here. So this is, again, in the early stages of what could be a long period of outperformance that we're looking at. You can draw your lines however you want to draw, but you basically have a series of higher highs and higher lows that has a relatively high chance of continuing. And regardless of what the chances of it continuing, what's attractive is the risk to reward. Husqvarna does not have to pull back very much before I would cut my losses and move on and risk a relatively small amount of my capital relative to how much I can potentially make if we do get that move here to the upside. 112, 113 is probably my first move here to the upside because, this fell pretty quickly from those levels down into the 50s. Now we've managed to grind our way higher here, and there's one last, I would say, major level here around 93 that it hasn't broken out from. And actually today we saw the stock trade lower from that level. Now, if I'm not mistaken, Husqvarna actually reports earnings in 1 week. I'm sorry, it reports earnings tomorrow morning. Okay, so this is one where a potential move here to the upside on the back of earnings. Earnings could really be the catalyst that actually breaks it out of that range and continues higher. So this is one to pay attention to. You won't be able to trade the options before the earnings come out tomorrow morning, but this is one that I think is worth paying attention to as to whether that earnings report comes out relatively strong. If it does, you will likely see a breakout higher here and get into a potential move here to the upside. But if earning fails and the stock drops, then this is one that I would stay away from because you're basically are able to kind of get a view into how the market is performing in the first quarter on that earnings announcement tomorrow morning. And lastly, taking a look at the financials. I was looking at Swedbank. Let's take a look at Swedbank here. Swedbank is interesting because, you've got this big move here to the upside in financials as a result of rising interest rates in Sweden. And you've had this big move here to the downside as a result of, what we saw in the US, the collapse of Silicon Valley Bank. But we've managed to hold this 167 level multiple times as support. And for the first time, we started to see things break back up above the moving averages. So this is the potential start of an early trend higher here. A lot of people, ask me, financials seems like it's a really bearish sector. Why would I look at opportunities in here? But from my perspective, the more bearish something is, the better the opportunity is. Because we all understand the concept of buying low, selling high, right? We all want to buy low and sell high. Well, how do we actually buy low? You can only buy low if you wait for things to get very bearish. And that's exactly what we've seen here in the financials. And what you're doing is you're not taking the most amount of risk as you are down here, right? Because that's really when we really weren't sure if there was going to be more contagion here in banking, whether there were going to be more banks that were going to fail. We had a pretty quick succession of multiple banks and Credit Suisse basically going under. And we weren't sure if things were going to turn around, or if there was going to be more contagion. But we're starting to see some of the early signs of financials recovering. You're now able to buy at a much lower valuation, even though interest rates remain near highs, relative highs in Sweden. And this is really where I think, there is some opportunity to play some catch up here in the Swedish banks. So Swedbank was the one that screened relatively well for me. There are obviously lots of other banks that you can pay attention to and take a look at, but those are some of the opportunities that I currently see in the market across the different sectors. And then more importantly, from a macro perspective, looking at the countries in Europe. Sweden and Danish markets certainly stand out in terms of outperformance, but even across the broader Europe markets, we see that outperformance relative to the US that has underperformed the US markets for the past 8 to 10 years. And we look like we're in the early stages of a more constructive move out of Europe. So with that, that covers what I wanted to share with you here today. Everything that I've shown you in terms of access to weekly education on the option strategies that you can use to trade these ideas, the OptionsPlay platform that you can use to scan for these ideas and structure these trades on your own and track these trades in your portfolio is all available completely free of charge at optionsplay.se, courtesy of the NASDAQ Nordic Exchange that has provided all of these services to you and Nordic investors for free. I just posted a link into the chat window for everyone. If you haven't signed up yet for a free access to OptionsPlay Nordic, you can do so at that link here on your screen, or clicking on the link that I just posted into the chat window. At this point, what I'll do is I'll open this up for some questions. If you have some questions, feel free to type your questions into the chat window, and I will answer any questions that you guys might have. Thank you so much, Karen. Joe saying, thanks, very interesting. Can you repeat why medical stocks perform great in times such as these? It's not that medical stocks perform great in these times, is that they don't perform as bad as other stocks. Because think about it, when there's a recession, you tend to, let's say, unemployment goes up, people are getting paid less, they're going to spend less money on consumer goods, right? Those are the sectors that are typically most sensitive to, an upcoming recession or more tougher economic times. Interest rates go higher. You buy, you buy fewer houses. You take out less credit. You're less likely to borrow. Any industries that are sensitive to that will kind of see that decline. But healthcare, if you're sick or if you need to go to the doctor, it doesn't really matter whether there's a recession or not. You have to go to the doctor, right? So that's typically why healthcare stocks tend to be more defensive in nature. You also see kind of consumer staple stocks, utility stocks. Those are the types of stocks that are more defensive in nature because you're not gonna not turn on your lights. You're not gonna not drink water. You're still going to continue to buy toilet paper. So, those types of things will tend to be more resilient during times of tougher economic times versus, more cyclical sectors. Thank you so much for the informative webinar. What's your prognosis for Swedish development with regards to are you talking, Darius, are you talking about that from an equity perspective or from a currency perspective? IV rank and liquidity is in the process of being worked on. It is not currently included in the Nordic platform just yet, but definitely something that we will pay attention to. So, your question about the currencies. So, I did look at EuroSEK, right? So EURSEK. What you see here is we're trading, sorry. If you look at the EuroSEK chart, you're trading near basically, all-time highs, at least as far as my chart goes back here. Actually, let's take a look at a weekly chart just to make it easier to zoom out here. You're trading near all-time highs in terms of EuroSEK, right? That means Swedish goods are cheaper for European customers. And predominantly when you talk about Swedish companies are exporting their goods, they're predominantly exporting it to other European countries. So this is favorable from an equities perspective because they're earning more Swedish crowns for every unit of goods that they sell to Europe. So that is one thing to consider. And this is part of why there's the currency tailwind is better for Swedish equities here at the moment when the Swedish currency is so weak relative to euro. If we look at euro Norwegian kroner, you have a fairly similar picture, right? The euro Norwegian kroner is also near all-time highs. So you have a very similar picture here in both Norwegian and Swedish currencies relative to Europe. And then if we take a look at euro, I don't know that there's a ton of trade between US and the Norwegian crown, but same thing. So very similar picture across the board for Swedish and Norwegian kroner relative to both US and Europe. And keep in mind, from my perspective, what drives currencies, from a fundamental perspective, long term, is really interest rate differential, right? So if you look at that interest rate differential between Swedish 10-year bonds and US 10-year bonds, you start to see that gap lower, right? And that's why, because of the lower of the gap, that's why we've seen this decline here over the past call it 8 months or so, 9 months or so in the dollar crown, right? And you haven't seen it in euro crown because the interest rate differential between Europe and Swedish kroner is still widening, right? Europeans are raising rates faster than the Swedish central banks are. That's why the euro continues to strengthen against the Swedish crown. When you start to see that either get in line with each other or start to outpace the other, that's when you're likely going to see this reverse lower here. So pay attention to what the central banks of Europe, or rather the euro, and the central bank of Sweden is doing. And if you pay attention to shifts in tone, shifts in policy, that is what's likely going to drive currency trends. Any other questions? If there are no other questions, I just want to thank everyone for your time this afternoon, or this evening rather. I hope that this is helpful in giving you an overview of the European markets, and specifically relative to the US markets, because this is something that we haven't seen in a very, very long time and worth paying attention to. With that, thank you so much. We'll send out both the recording and the slides as soon as we possibly can after this, so that you can review this at your own pace. Thank you so much, and I hope you guys have a great evening.